Gas Investment Board, April 17th. Kelly, would you please take roll?
Thanks. Jermaine Sullivan.
Here.
Liz Lasky.
Here.
Doug Parks.
Here.
Ed Bradford.
Here.
All right, and Jeff Rowe is off today.
Thank you. Old business Asher Oil update royalties.
So, we got the last check from Hound Resources. They were working on that transition to Asher, and, so I think we're on track. Got good contacts for them, and so if we have any snafus in the future, we'll at least be able to get a hold of them. So I'm expecting it to go smoothly from here on out.
Okay. Approval of minutes from the January 17th.
I'll make a motion to approve the minutes. The only thing under investment advisor, historic low unemployment, I think it's supposed to be 4.1, shows 14.1
Okay.
in the copy. So it's just,
I'll make the correction. Thank you.
with that correction.
We'd be in a world of hurt if that was the historical fund.
Yeah.
Right?
Yeah, that's a, we'd be in big trouble.
I just skimmed it real quick.
Good catch, Doug.
Did you make the motion?
Yeah.
I'll second that with the correction noted.
All in favor?
Aye.
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 A investment advisor update.
Was that a cue for us to start?
Yes. Yes.
Yes.
Okay. Hey, Woody, can you hear me? Yes. We have with us John Finkler. I think some of you may know that we introduced John at the last meeting that Troy Snyder will be retiring, and he was the head of our fixed income, and John is the new head of our fixed income. So you'll start to see his friendly face on a regular basis, and we're real excited about John being on board with us. Does everybody have a copy of the booklet in front of you?
Yes.
Okay, because I think what we'll do is we'll stay on video, and then we'll just refer to the booklet instead of screen sharing. And what we'll do is we'll start with page 4, which is Bartlett's market assessment. And this kind of hits the high points of where we are in terms of the capital market environment, the economic environment. And as you can see, we're generally, we have pretty positive business conditions relative to, multi-decade reference periods. We have fairly low inflation. We have low interest rates. We have low unemployment. We have GDP. The overall U.S. economy is growing nicely. Corporate profits are good. Of course, overlaying that is kind of emerging clouds having to do with a lot of uncertainty, mostly emanating from the tariff policy. So that's impacting consumer confidence, business confidence, and as a result of some of these developments over the last month or so, we've seen the prospect of a recession developing sometime this year from what might have been about 25% to maybe as high as 50% of a recession. Of course, that's not typically good for the stock market, and we've already seen evidence of that. And so some might say that we're within a range of already kind of taking into account that we might have a recession by seeing the stock market drop. I think at one point from the high to the low, from mid-February to in the last week or so, maybe about 20% decline, which is indicative of a potential recession. So some of the following pages we won't dwell on, but page 5 really points out that we have some pretty good dashboard of metrics for inflation, employment, GDP, interest rates, all those things that we talked about, pretty positive. I'll skip ahead a few pages. I think the last meeting, page 7, federal deficit, we talked about. That's kind of the elephant in the room. Certainly very concerning. I think the current administration is trying to deal with that through this Department of Government Efficiency. Remains to be seen how much progress we'll have there. I think some of these pages you've seen, from previous meetings. I'll jump ahead. So I think I'll wind this down and we'll open it up for questions from anybody from the group in terms of the economic environment that we're operating in.
So Woody, I mean, you mentioned the uncertainty, you know, an announcement one day, a reversal the next day, you know, countries coming to the table the next day, yada, yada, yada. Where does this go and where does this end? Where are you thinking on that?
Well, that's a good question. I don't know. I mean, you ask, 10 people at Bartlett, you might get 15 answers. My personal opinion is I think the president is very, his career is really, one, he's a tough negotiator and, everything is related to the art of the deal, but he also likes to be popular and he's referred to as a populist president. So, when you see the economy go in decline, you see the stock market go down, he's very sensitized to that and responsive to that. So I think that's good because a lot of this distress is, one person's executive decisions, and it can be pivoted very quickly. And so I don't think there's there's a cataclysm out there on the horizon. I think we have some checks and balances. The only checks and balance really we have is the job market, inflation, stock market. I think that kind of will work out well for us. But in the meantime, there's going to be a lot of turbulence, and I'm generally somewhat positive that things will work out. I think we're taking our reputation globally is taking a bit of a hit, but generally, that's kind of my feeling. And John, Brian, if you want to tag on to that, we'd love to hear it.
Yeah, sure. Can you hear me?
Yeah.
Yeah.
Great. I would echo Woody's comments. I mean, this is very unprecedented times at the current juncture, and we've talked a lot about in the past 4 months as we turned kind of the calendar here and it's all about consumer sentiment. With the consumer driving such a large portion of our domestic economy, over 2/3, we see that reverberating through different items, and you can see that in the volatility in both the stock and the bond market. It's a great question on where it ends. I don't know if anybody knows where it ends. I do believe that the more talk about conversations and coming to an agreement with some of these international players is a step in the right direction, and I think we see that in markets movements. When we get the headlines that Trump is having a discussion with different countries, we see that reflected in market moves. So it's so hard to tell where this ends, but what we do know now is, again, this is very unprecedented, and I think it's just a sign of kind of staying the course here and kind of just getting through these turbulent times.
So I have a more generalized question. When you've got tariffs on various products between two countries that have similar wage scales for their workers and similar regulatory stuff, and it seems like those are countries that if there were no tariffs, you would still have a country that has a natural advantage in one area, exporting more, and vice versa, but at least you wouldn't have these distortions that have been caused over the years where we've shipped manufacturing overseas to all these really low-cost production countries. And yet I see, there's like two different themes here, and it's kind of schizophrenic. In some places they're saying, oh yeah, we're going to go to zero tariffs with countries A, B, and C, but zero tariffs with a country like Vietnam that pays 20 cents on the dollar or 10 cents on the dollar, whatever it is. yes, we're getting cheaper products in, but that's not going to do anything to bring any manufacturing back, or especially in key areas. So it seems like it's kind of a schism there between, it should be evaluated on a country by country basis. Do you think that's where this is going to land at, where some countries that are more similar to the U.S.'s economy are going to maybe be lower tariffs overall, except for maybe a few key products, but other countries that have these distorted economies that are really siphoned off our manufacturing over the years might continue to be levied with tariffs?
Yeah, I mean, we all may have a different opinion on this. My thought is that, kind of the key metric that the administration seemed to hone in on is the trade imbalance between each countries, and that's how the tariff was kind of calculated for each market before this reprieve last week. So now, for 90 days, everyone other than China is at this 10% level. I think you may be on the right path. I could see us relaxing tariffs for countries where there's not as high of a trade imbalance, and generally that's going to be other developed countries. But if you wanted to pick a specific market, Vietnam, where we have a huge trade imbalance, a lot of manufacturing has moved there from China as labor in China has gotten more expensive over the last couple of decades. I could see markets such as Vietnam, us keeping higher tariffs. But I agree with you that the labor there is so much cheaper that I'm not sure a 10% tariff does a whole lot to move manufacturing back to the U.S. If anything, maybe it finds another market that's kind of the next Vietnam, somewhere in Asia or elsewhere.
One thing that's kind of interesting, Ed, that hasn't really had enough conversation is we've already had another tax or tariff, which is the currency. All these activities have reduced confidence in the U.S. dollar for various reasons. And as the dollar goes down in value, foreign products get more expensive. And it'll be interesting to see how that trend continues. But that's something that, we've had huge benefit over really almost decades of a dollar that's strengthening. And, everybody kind of works in dollars all over the world. And that's starting to, that could be kind of a melting glacier of sorts. And it's melting real quickly right now. Any other thoughts, questions, comments?
So, and maybe you'll get into this when you start talking about the portfolio, but with the pullback, has that opened up some buying opportunities for you folks where maybe a name was a little pricey and now it seems more reasonably valued?
Yeah, maybe Brian could probably talk on that more. We're kind of at our target level for equities. So if stocks were to drop significantly again, then that would allow us to rebalance and add some more equities. And Brian, maybe while you're on the topic, maybe you could talk about a couple of recent transactions, or maybe ones. I think it would probably be more things that we would add to. And maybe you could talk, Brian, about things that you're looking at that we might add to if the market dropped again.
Yeah, I think whenever you get periods of market volatility like this, it gives you opportunities to evaluate current holdings and also see what other opportunities are out there. So we're actually kind of in the process of making a trade now of upgrading a holding within the industrial companies, and that is selling FedEx, where we think they could be more impacted by tariffs globally, kind of a slowdown in consumer spending. And within industrials, there's a manufacturing company based in Ohio, but corporate headquarters are in Ireland just for tax reasons. But it's been a very high quality industrial called Eaton, and they're kind of at the forefront of this demand for electricity growing across the country, and the demand for building out the power grid, or the grid across the country. So a very high margin business relative to FedEx, and much more visibility into what their business looks like over the next 4 or 5 years. So you get some opportunities to upgrade in quality when you get some really high quality companies like Eaton sell off 30%. I think some of the tech names look very interesting here, which have sold off significantly. Unless you're kind of in the hardware space, the semiconductors are definitely a little bit more impacted. We've seen that in some news this week with NVIDIA. Even that still looks very interesting, but some of the software companies are very minimally impacted by anything that's going on with this, other than maybe short-term, very short-term. So, I think these periods of volatility always open up opportunities within the portfolio.
Okay, well, why don't we move on to the next item, which is, and we've been focusing our meetings in recent quarters on a special topic. And this month, or this quarter, we thought we would talk a little bit about recent stock market volatility. And there's a couple charts, and we'll take just a couple minutes and highlight kind of the history of market volatility and make it relevant to today. Brian?
Yep. So if you're on page 11, you'll see a history of market declines. And it, I think, is a good follow-up to the last question. And this page is a very good reminder of how often we have periods of volatility like this. So this specific chart goes back to 1987, so 37 years of history in front of you. And it shows the blue bar shows the largest intra-year decline within each of those years. And the green bar on top of that shows where we actually ended up at the end of each of those years. So just kind of focusing on more recent history within the last 10 years, we've had near 20% declines in four of those 10 years. So 2018, we had just shy of a 20% decline at the end of that year. That was when we put tariffs in place on China that year on steel and agricultural products. So that was only on about $200 billion worth of goods, versus today we're tariffing 3 times that, or put tariffs in 3 times that. We had a 34% decline in the span of 5 weeks in 2020 at the height of COVID, a 25% decline in September of 2022. That was the year that inflation peaked at over 9%. And then, of course, we've had the current decline that we're in, which the maximum decline was about 18% a couple weeks ago. So all that's to say is the average decline over that 37 years, on average, we have a 14% decline. So we're not down that much more significantly than that. But the key message is staying invested is vitally important. And 28 out of the 37 years, you have a positive return. And most importantly, the compound annual return over this entire time period for the S&P is about 11% annually. So you're rewarded for staying invested, accepting the volatility that comes with investing in stocks. And we know this is just part of the process, and there's always kind of a fog of war moments that we have investing in stocks, and we're certainly currently in one of those. And I think it always presents opportunities, as we just talked about, and you stay invested in, and don't focus on the headlines and stay focused on the fundamentals. And we should be rewarded for this as well. The next page shows the percentage of time that a 60% equity, 40% bond portfolio returns exceeded cash. And so very, very, very similar to how the Manistee account is invested, just slightly more aggressive than this at 65-35. But this was a chart that we saw from JP Morgan that we thought would be just a good reminder. So, with the volatility that you have in stocks, of course, if you have a shorter time horizon, performance will be more volatile, and you see that reflected in the one month, 1 year, and 3 year performance numbers. In 1 month, only maybe a little shy of 70% of the time will a 60-40 portfolio have positive returns or outperform cash. But even if you just go out to a year or 3 years, that number quickly exceeds 80%. And then over 5 years, almost 100% of the time you have positive returns. And the diamond that you see there, right around 80% of the time, you would outperform what you could earn in a money market. And then once you go out to 7 years, that number is much closer to 100. So just another way of showing that in short periods of time, volatility can obviously hurt returns, but you're rewarded for staying invested and keeping disciplined. And that's what we're continuing to do. So.
Questions? Okay, well, we'll dive into the investment review of the Manistee portfolio. And if we go to page 14, you'll see the asset allocation today. Well, actually, this was as of the end of the quarter, we were just about $14 million. And we're pretty much on target with most of the allocations. If you look at the table, we have these target allocations, and we're pretty close to that. And I see now also the internal loan has been repaid completely, Ed. I think this is the first quarter that we've had that. So I think we're on track with the goals that we have there. The next page is the equity sector allocation. And we've changed the format of this in the last several months. And you can see we've broken the 11 Standard & Poor's industry sectors, which starts at the top with information technology and goes down to utilities. We've broken them into those industry groups that are sensitive to the economy or tend to be more cyclical businesses versus those that are more defensive and are somewhat immune to economic conditions, and they tend to be very steady businesses. And you may have heard us say that, we tend to be a bit more defensive. We tend to like to preserve our stock's values relative to the Standard & Poor's 500 in difficult market conditions. And we've seen some of that recently, but this chart kind of shows that breakdown in terms of the Manistee stocks in the dark bar. And then next page, highlighting some of our fixed income holdings, John.
Yeah, if you look at the first quarter, it really highlights why you kind of have that fixed income allocation in your portfolio, just with the drop in yields that we had, and a reminder that when yields drop, prices go up. So it helps the value of your portfolio. You can see in that top middle chart a maturity distribution. We're maintaining in your portfolio really a kind of a balanced approach throughout all of those maturity buckets. What that leads to is an average duration of about 3.5 years with an index that's closer to 3 3/4 years. So we're maintaining duration or interest rate sensitivity as close to the index as we can. We're doing that recently we talk about that up in quality move. We've historically been overweight in the corporate sector, but over time we've allowed that corporate exposure to come down, and we're replacing that with more the Treasury agency space. Just again, kind of that up in quality as we kind of have hit some turbulent times. Just felt that was more prudent for the portfolio. And then the bottom right, the quality distribution, you can see pretty steady across the high quality space relative to the index. And again, we've allowed kind of some of that riskier, if I could say that riskier space to kind of roll down a little bit and reduce that exposure, and increasing that government and higher rated securities in the portfolio.
The Fed has kind of hit temporarily the pause button because they're getting whipsawed too, President would like the rates to be lower, they want to keep dry powder in the keg, the economy is showing signs potentially of sluggishness a little bit here and there, so they're kind of just holding, but I mean, where do you see interest rates, do you think, with your crystal ball trending, you think they're going to start lowering short-term rates again, or you think they're going to kind of just hold for a while?
Fantastic question, and at the end of the day, I could see that they're in a very difficult situation. They're in a situation where we could be facing a lower growth scenario, but with these tariffs, you could also have a higher inflation type scenario, and with that, the Fed is going to have to decide what they want to fight first. And for right now, we don't see the Fed reducing rates over the next couple of meetings. We think that they are going to remain on hold. They've kind of coined, if you remember back to 2020, 2022, they used the infamous word transitory to describe inflation, the thought that it would come and go quickly. They've brought that word back with these tariffs. So that they truly believe that this will be kind of a one-time impulse to inflation, but they haven't quite put their money where their mouth is. So they've kind of indicated that they're going to remain on hold, allow some of this volatility to pass. At the end of the day, by the end of this year, I could see them starting to embark on some additional rate cuts. The magnitude of those cuts, I think that remains to be seen. The fixed income market currently believes that there's going to be 3 cuts by the end of this year. But we don't see anything happening here, at least until the third quarter, until we can get through some of this volatility. We can get through some of this, 90-day kind of tariff pause and kind of see where things go. But the rhetoric out of Washington, between the president and between the Chairman Powell, the chairman of the Federal Reserve, has been quite eye-opening. It's obvious that the president does not like the Fed chairman at this point in time. He wants rates lower, but the reality is that they are separate institutions. And I think Chair Powell is doing a good job kind of towing that line, but they certainly have their work cut out for them. If you think about their dual mandate, they need to make sure that employment is at its maximum state and maintain stable inflation. I mean, that is their objective. And as of right now, inflation's been stickier on the way down towards their 2% target. And employment is hanging in there. But with some of these different policies that have been put in place, I don't think we start to get any sort of clarity on how those will impact the actual hard data until we get into probably the third quarter of this year. So I think the Fed's on hold here for a little while, but I could see them continuing with their cuts by the end of this year, but the magnitude of which I think is very hard to predict.
So they held the rates really, really low for a really, really long time after the 2008 recession, which was abnormal. And, back in the late 70s when we had hyperinflation, they were very high. But if you kind of throw out those extremes, what is a typical Fed funds rate? I know it fluctuates depending on the economy, but it feels like the Fed isn't likely to make that mistake of dropping those rates to zero again, are they? And there's no place to go from there except for all the quantitative stuff they do. Are they more likely to just kind of keep them at a 2%? Do they have a target for that, or?
Yeah, so every quarter the Federal Reserve lays out their projections for the next couple of quarters of rates. In addition to that, they lay out or project their kind of neutral Fed funds rate. And as of this moment in time, what they're projecting is it's lower than where it's at. But if you look at the average, federal funds rate over, call it the last 50 years or so, we are actually a little bit lower than where we've been over that average period of time. So you could argue that they're not as restrictive as what the market currently thinks or what the general market population currently thinks. So there's still some room to go to get to their ultimate long-term target rate. But I think they're willing to be slow with that, be patient with that, to be sure that they can get to that rate in a prudent fashion.
I just heard all the retirees and local units of government that have short-term money markets rejoicing because there's no place for them to put their money when the interest rates were zero, right? And now at least they've got a little refuge. I mean, we've made at the city here tens and tens and tens of thousands of dollars just by being able to enjoy those interest rates on our surplus funds, which has really helped with our budget. But for years, we didn't really have that luxury, you know, without it going way out on the curve, which you can't really do.
Well, as a fixed income investor for the past 20 years, when we had the yield curve inversion, so you were earning more in cash than you were putting money out on the long-term part of the curve. I mean, it's a very difficult situation to really justify, you know, why you would do anything. Now, you know, at least we have, to your point, you know, at least you're earning 4%-ish on a money market fund, but at least there is a positively sloped curve. So you're getting paid to take some additional interest rate risk. So as a fixed income investor, that's what you want to see. I think that's a healthy environment. But to your point, you know, if there's a need for cash in the near term, money markets are a great solution right now.
And John, the Fed's long-term, or what we call the R-star, their projection for where the neutral rate is, that's in the low threes. Is that 3.1, 3.2, something like that?
Yes.
So
Yeah,
Thank
I
you.
feel
So
like a
the
lot of
number, yeah.
people got used to zero interest rates and they're all freaked out that where we're at is, ooh, it's so high, but it really isn't. I mean, maybe a little bit, but it's.
Yeah, if you were to separate, you know, pre-COVID and post-COVID, or pre-COVID and COVID times, the COVID times were an anomaly. So if we look back to pre-COVID times, and we're really back to kind of a neutral perspective if we look back pre-COVID. So yeah, to your point, everybody was enjoying kind of that cheap money, not only from, you know, mortgages perspective, but from a lending perspective, and nobody wants to see higher rates.
This is Doug. Some of us that were around in the 80s, early 80s, remember the prime at 21.5, 3-year balloon mortgages at 16 3/4, and the bank lost money on every one of them when your cost of funds was over 18%. Yeah, you look at these, you go, you don't know what you're talking about. It's not terrible. You know, it hurts, but it's not where it used to be.
Yeah, and there was an inflation problem back then, so I mean those rates were justified.
Yeah.
Do you have a division on the stocks that you invest in dividend-paying stocks? Is there any rule that you're using, and will the dividends be affected with this possible recession?
I'm sorry, could you repeat the question?
You have some of these stocks, do you have a benchmark or whatever, or the percentage of our stocks that are in dividend-paying investments? And will those dividends be affected by if there's a downturn or whatever? Do you believe that?
Yeah, I don't think so. The dividend yield on our portfolio is very similar to the overall market. It's just under 2%, somewhere between 1.5%, 2% on average. And historically, it's somewhat rare. It hasn't happened very often where the dividends on Standard & Poor's 500 stocks go down for the year. There's been, I think, during the financial crisis, banks reduced their dividends, and that had an effect. But that's pretty rare, and I don't know that kind of a garden variety recession would lower the dividends. I mean, companies would have to lower their dividends or reduce their dividend. That's pretty rare. It happens, in isolated circumstances, but generally, pardon me, enough other companies are raising their dividends so that the overall portfolio is staying stable dividends.
Good.
Speaking of dividends, the next page are the dividends that Manistee gets. through the spending policy. And you can see on page 17, the history going back to 2008 and this dividend that we call the capital budget distribution. And you can see how that dividend has gone up. It might be, the better base year might be 2011. And that number is now up to, it's gone up over $150,000, even though we've reduced the amount of the return that we the percentage of the portfolio has been reduced a bit that we take. We were taking out 4.5 at one point. Now that's down to 3.5. But that keeps going up, and we're very, very happy about that. That it's really something very tangible that the Oil and Gas Fund does for the city of Manistee.
Just one clarification, we haven't taken the 26 distribution yet, the 440, and that's what it will be. So just to make sure we're
Oh.
clear on that.
Okay. Well,
That's what we calculate back in January for the upcoming fiscal year, so.
okay. So sorry about that, Ed.
Oh, that's
We
all
will
right.
get back-
It's what it will
we
be.
will
It's
fix
not
that,
gonna,
Ed.
it's not gonna deviate from that, but it hasn't been done yet, obviously.
When do we usually
Okay,
take
well,
that,
we'll fix
Ed?
that page. I'm not sure.
Pull that out like in August, September generally, and then we have it on hand.
But the amount will stay the same, because we already did the calculation.
Yeah, that's what we built into the budget, and it gets determined in your January meeting.
So that's the calculated amount, but not the distributed. It hasn't been distributed.
In fiscal year 26 yet. That doesn't start till July 1.
Yeah, okay. The last page that we like to draw attention to is the performance page. You can see that on page 19. And, it's been kind of a lackluster year through March. And of course, a lot of the activity in the market that hasn't been so wonderful has taken place in April. But, we're kind of break even through March. We're down 0.2%, where, the overall blended allocation for the market would have been down about 1%. But I think generally we're still on track. I think when we talked with Ed back when we started this fund, I think we were projecting that a return of something in the 6 to 8% range would probably be a good projection long term, and that's kind of right about where we are. We're at just over 7% a year, so we're happy about that, and we're happy with how the portfolio is positioned and how it's diversified. We're looking forward to taking advantage of opportunities as they present themselves over the next couple of quarters. Questions, thoughts?
Okay. I think we're good.
Yeah, it looks like we're all good on questions, Woody.
Okay. Well, thanks to Kelly for arranging the meeting and taking care of all the administrative things. She's been very, very helpful to us. And if anybody has any questions after the meeting, feel free to funnel those through to us, and we'd be happy to address them.
Thank
Very
you.
good.
Thank you.
John, I wasn't at the last meeting. This is Ed, but it's nice to meet you.
Likewise, appreciate, great to meet you, and appreciate the questions today.
Good. Okay. So anybody have anything else? No? We have no public comment, so I will take a motion to adjourn.
So moved.
Have a nice weekend, everybody.
Happy Easter.
All right, man.
Thank
you
you.
too.
Thank
Great,
you.
thank you.